Let me take you by the hand and walk you into the mind of the market, how to read its intent through price action. Before we dive in, remember the previous video on how to find big moves first. We laid the groundwork there. Today we climb another step. You and I, we both know the market doesn't speak in English. It doesn't hand you a sign that says I'm going to rally now. It whispers, nudges, stutters, hesitates. That's price action. And if you can learn to read those whispers, you won't chase movements, you'll walk with the market's current. Picture it, you're staring at a chart at 500s in the morning, coffee in hand, the screen quiet, only the candles dancing. What does that candle tell you? What does that pause tell you? What does that long wick or sudden gap reveal? That's what this talk is all about, learning to spy the market's intent. You have to become a student of the market's behavior. And as you learn that behavior, your money mindset sharpens. You learn when to stand aside, when to step in. You grow not by illusions of certainty, but by an honest relationship with price. So let's walk step by step through how to read market intent using price action and how that feeds directly into how you think about money and risk. We begin with a principle: price discounts everything. Everything: news, rumors, hopes, fears. They're all folded into price already. So when you look at the chart, what you're really seeing is the market's collective estimate of everything. That's why you don't need to guess every little headline. You just need to interpret what price is doing. Suppose you see a sharp drop in price, long red candles, volume rising. What does that whisper to you? Fear, capitulation, sellers pressing. Might it be a moment to lean short if your rules allow it? Possibly. But before that, you ask, is it a continuation, or is that a sucker's trap near the bottom? You watch for a reversal bar, a rejection wick, a bullish pin. You don't jump in just because price drops. On the flip side, when you see strong green candles ripping upward, volume confirming, you sense eagerness, conviction. But is it exhaustion near the top? A blow-off? That same question arises. You watch for signs: failure to continue, long wicks, indecision bars. The trick is you don't chase, you don't force. You let price hand you the clue, then you respond. You become the listener, not the shouter. Every swing, every pause, every breakout or failure, each is a statement from the market: this is how I feel right now. If you misread that, you'll fight the crowd. If you respect it, you can surf. Let's talk about structure: supply and demand, support, resistance zones. Price loves to revisit prior zones, test them, poke them, and see who blinks. That's where intent shows itself most clearly. Say price approaches a prior resistance zone. You ask, will it break clean, or will it stall and reverse? Watch the candles as it nears that zone. If you see multiple rejections, long upper wicks, sellers stepping in, that zone is still defended. Intent is to push back down. But if you see small candles, then a strong one punching through with volume, your suspicion should shift. Perhaps the bulls are taking control. Or take a support zone. When price comes down, if you see a hammer bar or a long lower wick rejecting downside, that's a message: I'm not done here. Buyers resisting. But if you see that zone fail and price drops through decisively, maybe your reading was too optimistic. You have to read the speed, the shape, the volume. You have to observe whether market participants care about that level now, or if they've moved on. Now, how fast is the move? If price darts through a zone in one candle, that speaks louder than multiple candles inching. That's brute force. That's conviction. But that same brute force can mask a trap. Always wait for confirmation, retests, follow-throughs, or signs of exhaustion. Is price trying to sweep a zone? Sometimes the market will poke beyond a barrier to shake out weak hands, then reverse. That's what we call a false breakout or a wick sweep. If you see a spike beyond resistance with little body, then a snap back, that's the market saying, I'm testing your resolve. Are you glued to a faulty bias? The wise trader questions that. We also look at context, the higher time frames. What do they say? Let's say on the daily chart, you're in a defined uptrend. Price is making higher highs and higher lows. Now on the 1 hour or 15-minute chart, you see a pullback. That pullback is a test in context. You expect some bullish intent to reemerge. If price shows signs of weakness, lower highs, no conviction, too much selling pressure, then maybe the trend is stalling. But if the pullback is shallow, candles show strength near support, that's the message we resume upward. So intent is read not in isolation, but relative to broader structure. Let me pause and ask you, did you see how this links back to what we discussed in how to find big moves first? There, you learn to spot where the market is gearing up zones, consolidation, suppression before breakout. Here, we're getting into the next layer. When that gearing up resolves, how do you decide whether that breakout is genuine or a trap? That is where reading intent through price action becomes your guide. Let's break down some patterns and signals you must observe. First, inside bars. When you see a candle completely inside the prior bar's range, that's contraction, uncertainty. The market is undecided. If that uncertainty resolves with a breakout, you watch which side wins. But don't get excited until it does. If it breaks higher but lacks follow-through, it might fail. If it breaks lower with conviction, then you lean short if your plan allows. Second, pin bars, rejection wicks. A long wick tells you that price attempted a direction and was rejected. The market tried to push but failed. That rejection is invaluable. Suppose a bullish bar opens, pushes up, but then the upper wick is long and the close is low. That's a signal buyers tried, sellers pushed back. That might warn you upward is weak. Third, engulfing bars. If a bar fully engulfs prior candleless, it's aggressive. But again, the magnitude matters. A modest engulfing in low volume is weaker than one in heavy volume. You want confirmation follow-through. You want to see continuation. Fourth, spike tail wick sweep. As I said before, sometimes the market pokes beyond a level, triggers stops and reverses. Price lures participants into believing a breakout, then reverses. You look for evidence. Did price close back within the zone? Did momentum fade? You stay alert. Fifth, break and retest. The classic. Price breaks through a zone, then comes back to retest it, and either holds or fails. If the retest holds, that breakout is more trustworthy. If price fails on the retest, that's a clue that the break was weak. Sixth, trend continuation vs trend reversal. You always must remain open to both possibilities. If you're in a trend, the pullbacks or consolidations are your best chance to see whether the trend resumes or shifts. Watch time, range, volume. A pullback that lasts too long or sees too many attempts may be inversion. But a shallow, quick test with strength near support signals continuation. Every time you see a candle, ask who is winning, the buyers or the sellers. Watch their struggle. Let them show you. Volume is your friend here. Without volume, most signals are weak. Price action accompanied by volume offers more weight. When a breakout candle is big and on volume, it presses. When it's big but on minimal volume, it might be a tease. Now let me talk about time. Time spent in consolidation, time in test. Time near a zone, these durations tell you something. If price spends too much time meandering, the market is uncertain. If after a long consolidation you get a strong impulsive move, that's meaningful. If price rushes through without hesitation, that's conviction. Okay, now layer in momentum speed. A move that's fast and sharp suggests strong intent. A move that's slow, indecisive, with overlapping candles suggests hesitation. Combine that with context and you build a reading. Let's run a scenario. Imagine price is in an uptrend on the daily. On the 1-hour chart, it's pulled back to a support zone. You see a small cluster of inside bars, a few attempts to push lower, but suddenly a green candle explodes upward, engulfing several bars with volume. That is your clue. The bulls say we want higher. The sellers cower, we can't push further. You then wait for a retest of that breakout. If price comes back and holds that breakout area, that confirms intent. You take entry aligned with trend. Your stop is below that support zone or the low of the retest. Your reward target is measured from the same structure. Alternatively, you might have a scenario where price is trending down on a higher time frame. On a lower time frame, price rallies into a resistance zone. You see a bullish move, then an upper wick, then a reversal bar, then a strong bearish bar. That tells you sellers have decided. You lean short. You wait for retest if available. You manage risk. You don't force it. As for money mindset, let price decide strength. Don't force trades because your account is screaming or your ego says I should be in something. Respect what price is telling you. You win not by fighting the market's message, but by aligning with it. Sometimes the best trade is no trade. Also, manage risk always. Price action is not perfect. You will misread. You will get stopped. That's part of the process. But if your position sizes and risk to reward are sound, those occasional losers don't kill you. The real killer is when you fight the story and stay in a bad trade because you're emotionally committed. Let me share another principle price action confirms itself. You don't take guesses without confirmation. If a breakout occurs, you wait. If you guess too early, you expose yourself. Let the market show you momentum. Let it show you conviction. Let it show you retests and follow through. That is confirmation. You must also understand false moves and traps. A false breakout is not failure, it's a message. The market is testing, fooling, poking. Every failed breakout is a test, and sometimes those failures lead into the real move. Your job is to detect whether a break is false or legitimate. You do that by watching what happens after the break. If the break fails quickly, price snaps back. With rejection bars, beware. That's a failed breakout. You might trade the reversal. If the break holds, volume supports it. Retest holds, then you lean in. One more thing, observe context, extremes, overextensions, exhaustion. When the market is stretched far away from value or structure, very strong moves often lead to sharp corrections. A long parabolic move is beautiful but fragile. If you see price far from any support zone, candles showing exhaustion, small bodies, long wicks overlapping, the intent is shifting, the market is preparing to rest, retrace, or reverse. Another subtle tool, order flow proxies, such as how price moves during sessions. Precession, late session, opening bars, they all carry characteristic behavior. If you notice that price consistently respects certain time zones or reacts in particular ways at session opens, that tells you participants' behavior. Those are little clues. Use them in conjunction with price structure. Also divergence between momentum indicators, if you use them and price. If price is making new highs, but momentum is lagging slower, weaker, that's a warning. It doesn't guarantee reversal, but points out weakening intent. Let me ask you, have you ever forced an entry because price should go your way, only to get stopped before the move you expected? That's because you didn't listen to price. You forced a bias. Don't do that. Let price guide you. Your mind must evolve you. From I want to be right to I want to follow what's true. Because in trading, being right is less valuable than being aligned. And alignment comes when you read intent correctly. Every trade idea you take should, before you place it, have the market speaking clearly. Here I intend to break. Here I intend to test. Here I intend to reverse. If you don't hear that, you don't enter. You wait. Also practice patience. Sometimes price is quiet. Sometimes it respects zones without testing. You sit. You study. You wait. The market will eventually act. When it does, you'll be ready. Let's look at another example, range expansion after a tight consolidation. Price moves sideways for hours. The range is narrow. Then suddenly one side bursts, perhaps upward, with volume and aggression. That's the market making its mind. That's your cue. But you don't jump at candle 1. You wait for candle 2 or 3 to confirm continuation, and then you may enter. And you watch if price comes back to retest that breakout zone. In that scenario, the consolidation was uncertainty, the breakout is decision, the retest is confirmation. That's the 3-step dance. Price action gives you each step. Don't confuse random noise with intent. Sometimes there will be whipsaws, false moves, but you let price separate signal from noise. One strong candle alone doesn't make a trend, a couple of follow-throughs do. Your risk management must always be firm. Stop losses must be logical, not too tight to be prematurely hit by noise, not too wide to be unacceptable loss. The risk you accept should be a small fraction of your capital, so that many small losses don't break you. And always measure reward potential. If the structure suggests a reward of 3 ties or 4 to your risk, that's a reasonable trade. If you're risking a lot for minimal gain, you're entering desperation trades, not intelligent ones. Never fall in love with a direction. If price begins to contradict your thesis, you reevaluate. You listen again. You may reverse or step out. The market is dynamic. Your thinking must be fluid. Also cultivate humility. The best traders are students. Each trade is a lesson. Don't pretend you know more than price. Learn from your misses. In time, as you gain experience, your pattern recognition becomes intuition. You'll glance at the chart and feel whether buyers or sellers are winning. But that intuition must be grounded in structure, evidence, confirmation. Let me share a small framework to identify the structure trend, range, consolidation, zone. Identify key levels, support, resistance, prior pivots, zones. Wait for price to approach a level. Observe price behavior, candles, wicks, volume, speed. Wait for confirmation, break, follow through, or one strong signal plus retest. Enter with logical stop and defined risk. Manage the trade, watch for signs of failure or reversal. Adjust if necessary. Exit when the structure suggests exhaustion or price invalidates your thesis. If you repeat that framework with discipline, you gradually shift from guessing to reading. You begin to feel the market's intent more clearly. I should remind you, today's principle, reading market intent, is exactly the logical continuation of what we addressed in How to Find Big Moves First. Back then you learned where the market may gear up. Now you learn whether it truly intends to follow through, or whether it's only flirting. These two pieces together elevate your edge. Let me pose to you. When you see the market gearing up, when you sense tension, what do you expect will happen next? Do you expect a clean break? Or do you watch for traps and hesitation? The better question is, what is price showing? If you condition your mindset to always ask, what is price showing right now? Your brain reorients from opinion to observation. That is gold. And in that state, you stop forcing your will onto the market. You step aside when no clarity exists. You strike when clarity arrives. Over time, your P&L will reflect not how loudly you talked, but how well you listened. You'll begin to see that big moves don't arrive out of nowhere. They often begin with subtle signals, tightening ranges, accumulative wicks, brief retests, quieter volume ahead of eruption. And then the market speaks decisively. You just have to be ready. At times you'll miss the first leg. That's fine. You look for the second test or the next pattern. Don't chase. Be patient. Let the market hand you signals. And when you act clean, concise, with risk intact. And here's one more mindset anchor. You don't trade for normal profits. You trade for asymmetric edge. You trade when the odds tilt in your favor. Price action gives you those tilts, and your discipline, your patience, your humility, those keep you alive, so you can exploit those tilts over many trades. So tonight, as you go back to study your charts, look for what price is whispering, token probes, failed breaks, retests, confirmation bars, wicks, fatigue. Ask, what is the market trying to tell me here? And don't force your expectation onto it. Lean only when the message is clear. Let me leave you with one thought to carry forward. If you can see intention before other traders do, if you can sense when price readies itself to commit, you gain the privilege of entering early, with less risk. But to do that, you must train yourself to read price, not predict it. We will continue this conversation, unpack deeper patterns, trade management rules, psychology of holding trades, and how to internalize that intent reading muscle. Reading intent means observing reaction, not predicting direction. That single idea can change a trader's entire approach to the market. The mistake most people make when they come to trading is that they believe their job is to predict. They stare at charts trying to forecast what will happen next, as if trading was some kind of fortune-telling act. But prediction is ego. Observation is discipline. The market doesn't pay you for being a prophet. It pays you for reading behavior and responding to it correctly. When you focus on reaction, you stop arguing with price. You stop demanding that the market fulfill your opinion. Instead, you watch what it does and align yourself with it. Ask yourself this. When price moves sharply against your position, what is the market trying to tell you? It's communicating rejection of your idea. And the faster you accept that message, the faster you protect your capital. Reaction is about listening. Prediction is about speaking. The profitable trader listens more than they speak. The price chart is a living conversation between buyers and sellers. Every candle is one side answering the other. You can't know what the next sentence will be, but you can recognize the tone of voice. Is it confident or hesitant? Is it aggressive or cautious? That tone visible in momentum, volume, and structure tells you far more about what's likely to follow than any forecast you could invent. When you trade by reaction, you're interpreting tone, not writing the script yourself. Imagine watching a resistance zone being tested. A predictor says, "This must break upward. The fundamentals support it." A reactor says, "Let's see what happens when it hits that level." The predictor buys early, confident in their logic. The reactor waits for proof. Does price stall? Does volume confirm? Do candles show rejection or strength? If price explodes through resistance with conviction, the reactor joins the move. If price hesitates or reverses, they stand aside. The predictor risks ego and money on an unconfirmed belief. The reactor risks only patience. You can't control what the market will do, but you can control how you respond. That's the essence of reading intent. You observe how price behaves around meaningful zones, support, resistance, trend lines, prior highs or lows, and you watch the market's reaction. If buyers defend support repeatedly, intent is clear. If sellers fail to push lower despite heavy volume, intent is shifting. None of that requires prediction. It requires awareness. Let me ask you, how many times have you been right about the overall idea, but wrong on timing? You predicted the direction correctly, but price shook you out before moving as expected. That's what happens when you prioritize prediction over observation. You can't force the market's timing. You can only respond when the timing reveals itself. A market may intend to go up eventually, but if you jump in before confirmation, you might be buying into the tail end of a pullback. By the time the true move begins, you're already out or underwater. That's why focusing on reaction, waiting to see the market's intent unfold, is the difference between theory and profit. The best traders are not the ones who predict the most accurately. They're the ones who react the most effectively. They let price show its hand. When price tests a zone, they don't guess, they watch the footprints. Does volume increase? Do candles close strongly in one direction? Does the reaction align with the broader trend? Each answer is a clue to intent. They piece those clues together before committing capital. Price intent is revealed in how the market reacts to key information, not in what you think should happen. Suppose a central bank announces something unexpected. One trader rushes to buy or sell immediately based on their prediction of what the announcement means. Another trader watches the first reaction, the spike, the retrace, the stabilization. They don't assume, they read. If the first spike fades quickly, that means the crowd overreacted. If it holds and finds support, the intent is real. The observer trades the reaction, not the headline. This is what separates emotion-driven traders from disciplined ones. Predictors are emotionally invested in their forecasts. Observers are emotionally detached, they simply interpret. When you observe, you detach your identity from the outcome. You're not trying to prove you're right, you're trying to see what's true. That shift in mindset changes everything about how you handle risk, entries, and exits. The power of observation lies in patience. You must be willing to let the market show its hand before acting. Most traders fail because they're impatient, they crave action. They can't stand not knowing, but observation requires you to stand back, to wait for confirmation. When price breaks a level, you wait to see if it holds. When volume spikes, you wait to see if the momentum continues. You trade the confirmation, not the assumption. There's a subtlety here that most people overlook. The market often disguises its true intent in short-term noise. False breakouts, stop hunts, and sudden wicks are all designed to shake out the predictors, the ones who guess without evidence. The market tests conviction. Only those who wait for reaction survive those traps. A fake breakout quickly reverses, a real breakout holds firm. Observation allows you to tell the difference. Let me give you a visual. Picture a chart where price has been bouncing between two levels for days. The predictor says, it's due to break upward soon. The observer says, let's see how it behaves when it gets there. When price finally approaches resistance, the predictor buys aggressively. The observer watches the candle form a strong push, then a long wick, then a weak close. That's rejection. The predictor is trapped. The observer stays flat or even goes short. The reaction told the truth. Reading reaction also helps you manage trades already open. Suppose you're long in a trend. Price begins to stall. If you're a predictor, you might convince yourself the pullback is temporary. You predicted a bigger move, so you hold stubbornly. But if you're an observer, you watch how price reacts during that pullback. Are dips being bought? Is volume drying up on down moves? If yes, trend intact. If not, if sellers start pressing, you adapt. You protect profit. Observation frees you from the tyranny of prediction because it allows you to operate in real time. You're not bound by opinions formed days ago. You're fluid, adjusting as new evidence appears. That's how you stay aligned with the market's true intent. Another layer of this is emotional neutrality. When you're predicting, you're emotionally biased. You want to be right. When you're observing, you're curious. You're a detective, not a preacher. The detective doesn't decide the suspect's guilt before the evidence. He follows the clues wherever they lead. That's the trader's job. Even your entries change when you adopt this mindset. Instead of trying to catch bottoms or call tops, you wait for proof of reaction. For a long trade, you want to see rejection of lows, a wick showing that sellers failed. You want to see follow-through buying. For a short trade, you want rejection of highs, then confirmation with momentum. You're not predicting reversal, you're observing rejection and joining when intent becomes visible. Ask yourself this: what's more reliable, your opinion about what price should do, or the evidence of what price is already doing? Every successful trader will tell you the same thing: trade what you see, not what you think. Because what you see, price reaction, is real. What you think is just expectation. And here's something else: observing reaction is not passive. It's active attention. You're constantly scanning for shifts, speed, volatility, volume, candle structure. Observation sharpens your instincts. You begin to sense when energy builds and when it dissipates. You can feel momentum fading before a reversal, not because you guessed it, but because you recognized subtle reactions. Even your money management becomes clearer when you focus on reaction. Your stops go below levels where reaction failed. Your targets align with areas where reaction is likely to change again. Everything becomes structured around evidence rather than hope. The truth is, the market rewards humility. Predictors are proud, observers are humble. Predictors declare, "I know what will happen." Observers whisper, "Let's see what happens." The latter survives because they adapt. The former burns out because they refuse to bend. Every great trading strategy, no matter how complex it looks, is built on this simple truth. Wait for the market to reveal intent through reaction. Trend continuation setups, breakout retests, reversal formations, all of them are reactions being read correctly. When price reaches a key level, you ask, how does it react? Is it absorbed smoothly or rejected violently? Does volume accompany the move, or does it dry up? Does momentum align or diverge? Each question strips away prediction and replaces it with observation. Let's bring in mindset. When you focus on observing reaction, you start thinking in probabilities, not certainties. You stop saying it will go up and start saying, if price reacts this way, I'll act that way. That language shift is powerful. It keeps your mind flexible and your emotions contained. It's also liberating. You no longer feel the need to be right. You only need to be responsive. You enter when price gives evidence, exit when evidence changes. You're always in sync with the market's rhythm. This principle ties directly to the discipline we discussed earlier about finding big moves. Remember how in that earlier talk we explored spotting, where tension builds before expansion? Well, this is how you know when that tension truly releases. You don't predict it. You watch the reaction when it does. The build-up is one thing. The reaction to breakout is the confirmation. Together they complete the picture. Traders who master this approach develop what looks like intuition, but it's really trained observation. They can sense when a breakout is likely to hold, when a trend is near exhaustion, when a reversal is forming. It's not mystical, it's recognition of familiar reactions repeating through time. So as you sit before your charts, resist the temptation to play prophet. You are not there to predict. You are there to observe, to read behavior, to interpret reactions. The chart will always show its hand to those who wait patiently enough to watch. Price reveals crowd psychology before fundamentals do. That's a principle that sounds simple when you first hear it, but it carries the weight of everything that separates a trader who survives from the one who's constantly caught off guard. Fundamentals are the story, price is the truth, and the truth always comes first. When you watch price move, you're not watching numbers flicker on a screen, you're watching human emotion in its rawest form. Fear, greed, hope, anxiety, they're all baked into every tick. The market is nothing more than a weighing machine for human behavior, and every candle that forms is the footprint of that behavior. Now, ask yourself this: have you ever seen a news report that says something like the stock crashed after earnings despite good results? Of course you have. Why does that happen? Because the price had already moved ahead of the news. The crowd had already positioned itself. They'd already expressed their belief through action. When the news finally came out, there was nothing left to buy. The story arrived late. The emotion had already run its course.